Welcome to the Tech Transfer Podcast. I'm here with JJ Richa, and we're talking about investing in early stage startups. So, JJ, will you introduce yourself and tell us how you make those decisions?
Oh, thank you very much. Again, JJ Risha, I am a serial technology entrepreneur. I have been investing since my exit in 2007. And how do I make decisions on investing in early stage startups?
Yeah, that'd be great.
Um, well, it's always about is it the jockey or the horse, right? So
Mhm.
it's always about the jockey. Sometimes the horse is important, but I think the jockey is much more important than the horse. So most of the investment decisions that we make, they're really based on how great the entrepreneur is, how great the founder is, how great the team is, in actually executing and being able to. Um, reach that goal and get that vision across to a potential exit.
Mhm. So, if someone's for a very young entrepreneur, like someone in college that wants to launch a company, that's going to be challenging for them. They won't have a track record. What's the right strategy? Do they get a more experienced person on board, or how would you handle that?
You know what? I think they just need to jump in,
Yeah.
and then adjust and pivot and along the way. But um, if they don't jump in, then the fear kicks in, and you wait long enough, and you won't do it. So they just need to jump in. The way that they get better, from my experience is really, first of all, is surround themselves with the good advisors, good people that really not only they're yes people, they shouldn't be yes people, but they should be people that really give it to that entrepreneur straight out. Tell them exactly what it is, but along the way help them through the journey, because the journey is very, very difficult, is very um, no one knows what that journey is unless they actually go through it. So surrounding themselves with the right advisors is great. Also, surrounding themselves with other founders, other entrepreneurs that are willing to jump in and see what where the journey takes them. But the team that they surround themselves with is very, very important, because they need to be not only complementary to their skills, but also mesh with uh, each other, so they potentially can get to build a great company.
Mhm. And so your first exit was in 2007. What stage did
That's
you
my last exit.
last exit? Okay, yeah. Okay, well, when was your first one and how did you get started?
I got started early on in 1993. I started my first company, and I sold that one in 2000. I'm sorry, 1998,
Mhm.
and then started others that failed. Then I started another one in 2000, and that one is the one that I exited in 2007. I did
Mhm.
start other ones along the way, but they weren't really companies to exit. There were more companies um, that I either joined or started from scratch, including a private equity firm. But so I've started others along the way, but that my big exit was in 2007.
And these were these all software companies?
All software companies.
Okay, great. And so you mentioned how hard it is launching something new. Why is it so hard? What are the big problems?
Well, if you are new, especially if you are a university student, and you either launch it while you're in school, or while you're taking getting your degree, or right after. um, there's so many variables, so many unknowns, about what it takes to build a team, what it takes to build a product, what it takes to, if we're talking university, tech transfer, what it takes to take that technology and actually commercialize it. Usually when it's a university technology, it's probably quite nascent, and it
Mhm.
needs so much before it becomes commercial ready. Um, so there are so many hurdles along the way, including, first of all, not knowing, um, you know, how to start a corporation, and what are stock options, what are stocks, and is it a C corp and S corp? What is a small qualified small business stock? What is what are the tax ramifications? How do you go and connect with investors if you're going to go and raise capital? Do you think people just have money on a tree and they just give it to you, or are you going to really, it takes a long time to raise capital, and the reality is it takes a very, very long time to raise capital. It's a almost a full-time job for someone. Also,
Mhm.
if you're new at this, or even if you have done this for a while, or have been working as in the industry for a while,
Mhm.
you have to have some savings. You have to understand that there are a lot of risk. It's just not going to work from day one. So I just mentioned a few things. It's very, very difficult, and the unknown is so big that most people don't even leap into jumping
Right.
to actually do this because they're afraid of that unknown. Um, but as I tell people many times, if you have experience, if you are a software engineer, if you are a doctor, if you are a biologist, whatever it may be, um, if you have an idea, jump in, try it. You can always go back if it doesn't work. You can always
Mhm.
go back and find another job somewhere, as long as you don't wait 10 years before you find a job again.
Yeah,
But
that's
uh,
right.
but take a leap. Yep.
Well, that's what I tell students is that it is the best time of life, the least risky time in a lot of ways. And
Yeah.
do you feel like it's a little easier? So you mentioned that just the quantity of decisions you have to make with maybe scarce information, it's hard to research all these issues. But research, because of AI tools, it's gotten so much easier to research some issues, especially venture capital, I'll say. Do you think it's easier in some senses now than it was back when you first did it?
You know what? I think it is easier. What's really interesting though, I mean, you could find information anywhere, regardless if it's with AI or without AI. You could search online, you'll find stuff, right? What you can't do is you replace the human interaction. You're not going to be able to raise money by just doing connections on LinkedIn or just emailing somebody and say, "Give me money." It's not going to happen. You're going to have to build that relationship. So that's not going to change forever, at least in my opinion. So that part of it, the human interaction, is not gonna that won't change, especially for raising capital, but also for building a team. You cannot build a team and have the right cohesion and without being really together in one place and understand each other and build the right product, etc. So the tools are out there, the research is out there. So we do a lot of like you do a podcast, we do some webinars, we do events throughout the year as well, and just to educate entrepreneurs. But you know what? Not too many come to these webinars anymore and listen to the podcast anymore because they figured if I want something, I can go find it. AI will find it for me, or I'll research it and I'll find it. Um,
Yeah.
but what I've noticed lately, and maybe you have, but I know some of my colleagues, some of them said, no, no way. But what I've noticed lately is that um, because these entrepreneurs are finding all this information online, they think they know it. And they just come to you and say, just give me money and I'll be $1 billion company. And, the likelihood of that happening is almost nil. Um, they need all the stuff we talked about along the way. They need to build that journey. They need to understand the process, and you can't just do it by having money because let's say some investors give you money the first time around and you don't know and you actually fail, you may not get the opportunity to do it again unless you have shown that you were able to really go through the process properly.
Mhm. Okay, and so you're with that background, you're at Pismo Ventures now in Irvine, right? So you're investing in companies, the Irvine, California. What is the thesis for your fund? What are you looking for?
So we don't have a fund. So Pismo Ventures is a venture firm very early stage companies, pre-seed, seed, and maybe up to A as well. Again, the definitions have changed over time as well. Um, and so, but what we don't have a fund. What we do is we create what's called SPVs, special purpose vehicles, on a per on a per investment basis. So every time we see an investment or an investment opportunity comes up, what we do is we go to our investors and we let them know about it. We show them the due diligence that we've done. Sometimes, most of the time, we don't lead, so we actually follow on somebody else's lead, and we look at the due diligence that they have, and then we ask our investors that are part of our network to be part of a potential due diligence. Um, but our to talk about what we invest in, we are pretty agnostic. But again, the most important is the team. Second is it has to be tech focused, because it needs to be scalable. And then second is uh, there needs to be a potential exit for in a large market. The reason is because without the exit, there is no return on investment for the investors. So they need to have some kind of an exit in order to get some money back and then maybe reinvest in the marketplace. What we don't do, we do pretty much everything except potentially, long-term biotech or pharma, where it's going to take 15 to 20 years to, potentially get an exit or return on investment. The other thing that we don't do is CPG products. Again, there has to be a more tech focused in order for us to, leverage the scalability, or the companies leverage the scalability, so there is a potential, fast growth.
Okay. And it'd be really surprising to some entrepreneurs if they went through the process of creating a company and then there wasn't a good exit proposition. What's an example where that might happen?
Oh, wow. I think it happens much more often than you think. You know, uh, it's happened a couple of times. Well, it's happened many more times than a couple of times, other than failures where companies that we invested in, um, they actually got to a point where they're making, let's say, 15 to 20 million, maybe 25 million a year. And the founders, usually two or three people, are now generating and taking home really good chunk of money. And they decide that maybe there is, we don't want to grow anymore, or we don't want to, there's no reason for us to exit. And if that happens, then the investors that invested in that company are not going to get the reward that they, at least planned on a few years back. Um, it does happen quite often, more often than you think, because most of the time when companies that exit, usually they need to generate an enterprise value maybe of 100 to 150 million. That's usually kind of the exit value for companies. Um, uh, More life science companies, they're a little bit more than that, of course. But most companies that investors, micro VCs, angels invest in, they're gonna exit between, say, 100 million to 300 million on average. Um, so if the transaction or the enterprise value is much less than that, unless there's some kind of a strategic uh, positioning for an acquirer, it's probably not going to get acquired.
Hmm. So if you're an investor and you get stuck in one of those situations, the startup company's just not going to be able to exit. Do you just sit back and say, well, I'll take my shareholder income, or do you try to sell your shares to the founders? What do you do?
Well, it depends what the, shareholders agreement is all about, right? And at when the investment is all about. So um, one situation, I'll answer it in a couple of ways. Um, you know, there are multiple ways to actually invest, right? So there's what's called SAFE, there is a convertible note, and there's equity. So these are the most common, right? So if it's a SAFE, and there's no potential without going into the detail what safe is, I'm sure people will look that up. If there's no potential way to raise capital down the road after that safe has been executed, that safe is not going to convert into equity, and so um, the investors have no recourse. So really, it ends up being the investors really lost their money completely because there's nothing that's going to trigger a potential conversion into equity.
Mm.
Um, if it's a convertible note, then if it doesn't convert, so the investors have a little bit of recourse because it's still a loan, right? So because it's a note. So we've had a situation before where it took us 7 or 8 years, and then we kept asking to get the interest and the money back, and we didn't. But finally, it took after we kind of threatened the company and with legal actions, then they actually paid because they didn't want to lose what they had, which was something really, really good for them, but
Mm.
not good for the investors.
Mm.
If it's equity, I guess the one option they have is really, getting some potential dividends out of the company, right,
Yeah.
along the way. And if you don't have a choice, I don't know what else you could do except continuously take residual or dividends income from the company. Um, if there are ways, for I don't know, in the convertible note or in equity to actually sell to, usually there are ways to sell to the outside. Again, how depending on how the shareholders agreement is written, you can actually sell your shares. Usually the team or the founding team or the current shareholders would have a first right of refusal and to buy it. Otherwise, if they don't, then you can probably sell it to somebody on the outside. But
Mm.
again, who would buy it?
Right. Right. Not what you want to walk into.
Yeah.
We good. Well, you mentioned also that you structure deals, you use SPVs, special purpose vehicles. How does that work and what's the upside?
So a lot of we do it a little bit differently. What we do for SPVs is we create an SPV for the company. It's dedicated. So there's one thing on the upside for the company is that let's say we have 20 or 30 investors. All these investors would invest into the SPV, which is basically an LLC, and then this LLC would invest as one entity into the company. So there's only one entry on their cap table, which is a very important thing for the company usually. Um, for the investors, we're doing most, and actually for the companies themselves, we're doing all the legwork. We're connecting them with the investors. We're bringing the opportunity to the investors. So it's a lot of potential synergy and a win-win for all party involved. For the investors, also usually when they are in a fund, they usually pay a 2 and 20, which is the normal fund, which is 2% management fee on a yearly basis, and 20 is the carry, and the carry is basically on the back end. Basically, the manager of a fund will take at 20% of the profit at the end of after returning all the money to the investors.
Hey, is that the same terms as a typical VC fund as well?
So that's all the VC. But that
Yeah.
was just explained. That's the normal. But we don't do it that way. We don't take any management fee, so there's no 2%, and we only do 10% carry on the back end.
Hmm.
So it is more friendly to the investors because um, we're not at the typical 2 and 20, so it's 0 and 10. And the 10 is basically after they get their money back, then we keep 10% of the remaining profit that the net profit that the fund or the SPV
Hmm.
created.
For an investor, they like the incentives because you're getting paid after the win as a percentage of the win, essentially.
That's right. Yeah. So I mean, simple. If let's say investors invest $1 million, and the company 6 years later sells for, let's say, only one investor, right, or one
Okay.
SPV in it, and it's 10 million, then we, the that's the 10 million for the SPV. Then what we do is we give the investors their first $1 million back because that's the investors' original capital. And then out of the 9 million, we take 10% of that, and then the remainder gets split to the investors in the fund again.
Okay. And you mentioned that for the startup company, the entrepreneur likes that there's only one investor on the cap table. Does that
Yeah.
just make it look more deliberate to other investors, or what's the advantage for them?
Well, there are limitations, and I don't quote
Oh
me
yeah.
100%. There are limitations on how many, attorneys would know a lot more about this, on how many investors can be, or equity investors can be on a company. I think the number is 600. If
Mhm.
it's more than 600, then there are, again,
It's
don't
SEC
quote me, but
regulations.
it becomes automatically a public company, or some ways where there are
Yeah.
things that happen automatically, or you'd have to do certain things to minimize or stop that. But
Mhm.
also, other than the number of shareholders could be in a company, it's a huge amount of work for a company to manage that many hundreds of investors on their cap table and continuously update them and keep them informed of what's going on. So it becomes a nightmare trying to manage so many on a cap table.
Mhm. Okay, great. So when you're looking at companies, you're thinking about all these issues. You mentioned your top three there. One thing that hasn't come yet is intellectual property. Is that important to you? How important is it?
Oh, it's hugely important, and also it depends on the type of industry, right? So, life science, it's almost like,
Yeah.
it's mandatory to have the right IP, medical device, whatever it may be. Um, in some types of industries, it could be software. Well, it could be, sub areas or sectors in the software. It could be cybersecurity or crypto or whatever that may be. You would need to have some kind of protection. If it's a normal, your SaaS type thing, most of the time it's going to be really hard to get some kind of an IP or patent and
Yeah.
to protect you. It becomes more of an execution play. That's where really the team needs to be a stellar team in order to reach a point where they can grow the company properly. Um, but having a moat, having some protection, um, uh, regardless of it's a patent or whatever it may be. It could be a secret sauce that they never reveal, right? That's still a protection as well. That's really important. But having a moat where you can keep potential competitors away for a period of time is really, really important.
How good a moat is the SaaS model? If you say, like, my software isn't really patentable, there's nothing I can do, it's the copyright isn't doing much for the code, but I'm going to provide a SaaS service so people are just seeing the web interface, they don't see the secret stuff I do, and they get the result. Is that a good moat, or should we think, well, once you know the functionality, anyone can deconstruct this?
Unless they have something that's, yeah, I think anybody can construct this, but unless they have something where they, sorry,
Oh, that's fine.
unless they have something where they have some kind of a algorithm, right? Or that's proprietary to them, where they're using special methodologies, math, whatever it may be, that can produce results that they can only produce, and to certain accuracy better than others. I'm not sure you can have a moat for a SaaS. I mean, if
Mhm.
I still sometimes see companies trying to develop e-commerce software and
Yeah.
don't understand, where the moat is, and there's so many out there. And e-commerce is e-commerce. They got to have something that's different in order for that e-commerce software to be of value.
Mhm. Yeah, what if you do enter the market with a new startup that's not very protectable, say it's e-commerce, SaaS, some product like that, and you could take the position, well, the market is so big that even if I can't exclude others, there's enough to go around. I'll be able to survive. Is that just too limiting? What do you think?
It is too limiting. Again, unless you have something that's different. Usually, sometimes companies come and say, "Oh, we're going to be much cheaper than others," and usually that's not a good moat
Yeah,
because if you're cheaper, someone will probably still beat you to the price. Um, but it could be an execution play. It could be a some feature that no one had before, and you execute properly. I mean, it's happened. It's happened many times where um, companies come with and they add like one was it Instagram, right? What did
yeah,
Instagram have different? Right? They
I
they had
know.
they just had the different exposures, right? And
The filters, yeah,
filters, the filters.
yeah,
Thanks. And that's all they had, right? But they
yep.
did it right. And like everybody else can do that. Of course you can do that. But they still did it right and they were able to succeed. But so there are ways, it could be the marketing, it could be the sales, it could be whatever that is a little bit different that clicks with people and that creates that buzz and then when you have a name, then people are going to follow you.
Mhm. Have you ever seen a startup where what's really valuable is the user base? Maybe it's like Instagram. They've created something obvious-ish, but millions of people are using it, so it is valuable.
Well, again, WhatsApp was
Yeah, yeah.
it's one of those, and I think they got sold for 20 some billion dollars
Mhm.
to Facebook or Meta. But that's another one. It used to be the eyeballs, right? It's everything about the eyeballs. I think there's some validation to it, but it's not as much anymore. You have to have some revenue. You have to have something. But again, I'm still surprised at times how companies get there.
Yeah. Well, great. Well, I know, JJ, we're about out of time, but what's just advice for young entrepreneurs who are thinking of maybe taking a technology out in the market? What's something smart they could do that they're not going to think of on their own?
Um, I think planning is the most important thing. So I don't just jump in and not having a plan ahead of time. Um, maybe plan it. Have some reserves um, before you go and jump into something where it may take a long time before you get to generate some revenue. Um, What's really smart would be to also, again, I think I mentioned that is to surround themselves with the right people, right advisors, right industry, some advisors, board members that can open doors for them, because that sometimes is much more important than any of the technology that they may have or they may develop, is someone to actually open the door. I'll say one more thing, and that is. You know, me learning it the hard way. Right now, when I invest in companies, of course, as I mentioned, we look at teams, we look at the founders, the entrepreneurs, and how they are and how they, mesh together as a team. And of course, that the technology needs to have a moat. But then the next most important thing for me, other than having the team and the right technology, is what I call the distribution model. How are you going to get that into the hand of your end customer, be it a consumer or a business? And usually it's one of the hardest things that you could do, because most of the time you're able to develop that technology, you have the right team, and then there's no way for you to get it out there or to sell it in an easy way. So my one example that I have would be, if you can have a zero customer acquisition cost and a very long lifetime value, you're going to be a winner.
Yeah. Okay. Fantastic. Well, great advice. JJ, thanks so much for joining us and sharing these insights. Really appreciate your time.
Thanks very much, Dave. I appreciate the invite.
And if you think your company might be right for JJ's firm, there's a link in the description. You can apply there.